Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey folks, welcome back. You know what? I have interviewed a lot of folks in the self-storage asset class over the years, but today's guest, zooming in from sunny Chicago, Fernando Angelucci, has a very interesting story. He went from like $100,000 in debt to these days, he's got a $250 million plus portfolio of self-storage facilities. And if you're watching this on YouTube, you're looking at Fernando's handsome face. He's not very old. Like, this is not a 3-decade process or anything like that. So Fernando, great to see you. Welcome to the show. Great to have you.
Yeah, thanks for having me, Dave.
So I gave you a bumbly kind of introduction there, my friend. So maybe give us a quick little Coles Notes about, I think you were a broker or realtor or something like that first. So I'm just curious, like, what caused the $100,000 in debt, and then what kind of caused you to pivot into buying stuff?
Yeah, so I was not a broker or a realtor first.
Okay.
I started off wholesaling houses, so contract assignments. And how I learned to do that was by originally cash advancing as much as I could get off credit cards. So I applied for something like 64 credit cards in one night.
That might explain the $100,000 in debt. Now it's all very, very clear. Easy to burn through some cash.
Yeah. So I got 12 to 14 approved, and then when they all showed up in the next week or two, I just maxed out the cash advance limit that they had.
So that was for buying deals, for doing marketing, for doing all the stuff that's required to get a wholesaling business up and running.
Exactly. Yeah. Startup capital. So you start doing the wholesaling, you have, it's not very tax efficient income, fee-based income, or short-term capital gains, depending on how you're doing it. And then we needed to put that into a more tax advantage place. So we started buying real estate, single family and multifamily homes. Okay. And very quickly, I turned into a tired landlord, realized that all my problems come from the 3 T's, which is the tenants, toilets, and trash. And then we went into self-storage in 2016, first on the contract assignment side, and then 2018 is when we started buying assets with our investors.
Okay, very good. So the question I love to ask self-storage guys, Fernando, is if you were talking to somebody who just had no clue about this asset class and they said, hey, what's the big benefits to self-storage versus everything else you can do in real estate? What would be your top few reasons why you love self-storage?
Yeah. So when you look at the returns from self-storage over the last 30 years, they have outperformed almost any other real estate asset class. So on average annual return of about 18%. In addition to that, I don't have to deal with any of the legal parts that are most frustrating with habitation-based real estate. So no evictions, you don't pay within 30 to 45 days. I've auctioned off your stuff. And I don't show up in the newspaper as a, big bad landlord that kicked out, the grandma,
little old grandmother in the middle of winter,
exactly.
Middle of winter in Chicago. Yeah. You don't want to be that guy. Yeah.
Exactly. And then in addition to that, very low manpower needed to manage an asset that let's say I buy a $18 million self-storage facility versus an $18 million apartment complex. That apartment complex is going to need about 5 times the staff in order to operate that. So very easy operations, a lot more efficient, and pretty safe when it comes to the state laws being written in the owner's favor, as opposed to many landlord-tenant laws being against the owners ultimately.
So as of right now, we're in the middle of 2026. What does the portfolio look like? What does it consist of? How many different facilities across how many different states, counties, towns? Give me a little snapshot there, Fernando.
Yeah. So we're selling off our 4th vintage now. So most of the assets in this vintage are going to be ready for sale either between right now and the beginning of next summer.
So what does that actually mean? 4th vintage?
Yeah, so our process is not a long-term buy and hold process. So what we do is we come in, we do heavy value add, and then once we reach peak equity, we start selling off in larger portfolios. So Because we have three main strategies. The main one is a portfolio wrap-up strategy. Consolidation is a huge buzzword in the industry right now. So we'll buy these mom and pop operated facilities. We'll increase the size, we'll increase the revenue, we'll drop the expenses, and then we'll put them into somewhat homogenous portfolios of anywhere between 10 to 20 assets and sell those all off, up the feeding chain. So, we're buying from people that kind of treat it like a hobby, and then we institutionalize it. We make it a professionally run outfit, and then we sell them in tranches of $30 to $60 million off to usually either the publicly traded REITs or the top 100 privately held REITs.
Very, very cool. Well, that's a big leap up from a guy that was doing wholesaling a few years ago. So how'd you get so smart so fast around doing this kind of stuff, Fernando?
Yeah, so the biggest thing was learning how to raise money. That's like, if you're a real estate investor in any sort of way, it should be your number one skill set that you work on. So very quickly you run out of your own capital, then you run out of your friends and family's capital, and then eventually you're going to have to start raising money from strangers. And how do you do that? So how do you bridge that trust gap? How do you show that you know what you're doing, that performance? This is one of the things that we do. You're going out and educating the market to dominate the market. And then, very quickly looking at who is going to be our buyer. So instead of just buying real estate for the sake of buying real estate or for getting cash flow, but ultimately buying real estate with the exit in mind before we even go after those properties. And what we realize is there's great arbitration opportunities from, buying these hobbyist style facilities, getting them up to an institutional size, usually above 60 to 65,000 square feet, and then putting them into portfolios to sell off to the larger operators. Because those larger operators, they don't want to, spend all their Ivy League analyst time to buy a $1 million facility. They would rather use that same exact amount of man hours and salary power to buy a $30 million or a $60 million portfolio. It's roughly the same amount of underwriting and manpower needed. So what we realized is the biggest opportunity is helping this consolidation that's going on in the business and being the middleman between the assets that the buyers don't want to deal with, taking them down, putting them into a form that they do want to deal with, and then selling them off to them.
That is really, really smart, Fernando. Yeah, thanks for sharing that. So when what did you call this? A vintage, like a batch of properties that you've bundled all together and optimized. And now you're selling them to a big guy.
Correct.
Couple of questions there. To make them homogenous, are they usually looking like geographically based, size based? Like what makes that batch of, I don't know how many different facilities would make up $30 or $60 million chunk? Like how many different facilities does that typically look like, and how do you batch them together for these guys?
Yeah, typically it is 10 to 20 facilities in one portfolio.
Yeah.
A couple years ago, call it 5-6 years ago, the geography was not as important as it is now. So, for example, this vintage will have assets in Illinois, Ohio, West Virginia, Michigan. So all kind of in that Midwest is this piece of the portfolio. And while we're doing that, we're building up the next vintage, which is going to be the kind of the Northeast. So New York, PA, Massachusetts, those types of areas. And then the way that they look is typically we want to raise the grade of the facility when we buy it. So let's say we're buying a Class C facility that may, just have some fencing and gravel. What we'll do is we'll come in, we'll pave, we'll put state-of-the-art security, entrance and exit, keypads, lighting to make it feel safe and comfortable for the primary customer in that market, increase the revenue, put everything on the same type of operating system, same type of expenses, making sure that we're, bringing the insurance on into our portfolio insurance. So that's some savings, contesting the property taxes. And then eventually, if there's space, actually increasing the size of the facility itself. So either using modular portable units if you don't have any buildable area because of easements, or if you do have buildable area, expanding the entire facility to get up to what those institutional quality buyers would like. So typically they want things that are, state-of-the-art security. That's kind of the biggest thing that we're seeing right now, especially after the pandemic. Break-ins have been increasing across the industry. So now there's a renewed focus on security, lighting, access control, things like that. And then making sure that it produces the type of revenue that would make sense for an institution to come in. So, for us, we're typically saying by the time we're done with stabilization, each one of the facilities needs to produce around or over $50,000 in gross revenue per month. And then that makes it a pretty easy yes from these larger operators. And the reason we want to go to these larger operators is because they have cheaper cost of combined capital than we do. So, when you can go out to Europe and offer up a bond at sub 1 or 2%, so now your equity is at 2% when my equity is at like 18 or 22%. Yeah. And then when you're able to get lines of credit that you can operate where you're paying maybe half of market rate, so call it 3 to 4% in debt, your combined debt is 2.5–3%, which means if you were to buy a 6 cap, you're doubling your money. Whereas if I'm buying a 6 cap, I'm already losing money. Yeah. So yeah, exactly. That's why we want to sell to those guys. We don't want to sell to other people like us because the other people like us are also very good at negotiating the price down to get it to where they need based on their cost of capital.
The big guys with cheap capital. That's
right.
Yeah. It's very, very cool. So Fernando, so right now you mentioned you're working on this next vintage. Typically, how long does it take you to build it up and optimize it? Like, what's the turnaround time for like one batch?
Yeah, it's usually going to be anywhere between 3 to 5 years.
I would think so, yeah.
If you're looking at individual assets, it could be faster, but because, you're constantly buying and selling and some of these assets are different points of the value add process. I mean, there's assets that we'll buy that are already cash flowing and all they need is, some lipstick versus there's some sites where we'll just buy the land and we'll put up an 85,000 square foot facility from scratch. So like that's going to be the longer lead items where it could take anywhere between 4 to 5 years for that to be at peak equity to be able to sell. So around 3.5 to 5 years is a pretty good estimate.
What do you find is working best for you these days in 2026 for finding these properties? Because there's a lot of competition in the market there, and some markets are a little bit oversaturated from what I've understood. So what do you guys find works well? Yeah,
so just because we come from the wholesaling side of the world, it's off market is the number one
direct
thing.
To seller.
Direct to seller. I always make the analogy. If you're going to go to an auction house, would you rather go to the auction house as 3 people bidding or 1,000 people bidding? That's the same thing it's the same equivalent of going to a real estate broker to find you self-storage properties that are listed versus you going out and getting to that property before a broker can get to it. So we find that direct mail, cold calling, email blasting, and then even showing up to not only the state but the national trade shows so that the sellers can see that, hey, we ourselves are also operators. There's a kinship there. And then just being able to stay in front of them. So self-storage is unlike single family and multifamily in the fact that it's very difficult to find sellers that are in distress just because these things are, pretty cash cow heavy when it comes to operations. You're only looking at anywhere between 35 to maybe 40% of your total revenue going to expenses. So it's very difficult to find somebody in distress. So then the second piece is, can you be in front of them when they start making these major life decisions like retirement, or I want to travel, or none of my kids wants to take over and I don't want to sit behind the desk anymore. So what we find is that in general the best deals we get are the ones that we've been talking to the seller for easily 3 to 5 years already.
Wow.
Just staying in front of them every quarter to every 6 months. And
that's what I was going to ask. So direct mail every 3 to 6 months, ding, something showing up on their desk. And
and then not only that, but offering, value. So leading with contribution, not just calling them and say, hey, you ready to sell yet? Because that gets pretty annoying pretty fast. But they're going to be looking forward to Fernando's calls when they get a call and say, hey, I got this new property management software that's coming on the market. Would you like to take a look? I connect you with a guy. Or, hey, I have this new insurance broker that was able to reduce my entire portfolio down by 20%. Is that something that's worth it for me to connect you with? Or here's a guy that just contested my property taxes and saved me 25 grand on one facility. Is that something you like? And then eventually when they are finally ready, the first person that they usually think of is us. And they call and say, hey, I'm going to sell this. I want to give you guys a shot before I list it. Do you think we can get to a number that makes sense for both of us?
Very, very cool. That makes a ton of sense, Fernando. So what kind of volume of transactions are you doing? I understand it's different every year, but let's say on average, the last 5 or 6 years, how many purchases have you been doing a year?
Yeah, it'll fluctuate between 8 to 15 a year, and not all of them we are buying ourselves. So every once in a while, we'll get a deal that it looks pretty good and we go through all the underwriting and just for whatever reason, it doesn't hit one of our major metrics. So we'll assign that over to someone else that, let's say, they like that market or they like that
You're
size of
keeping
an
your
asset.
fingers in the wholesale business as you're doing this.
Oh
huh?
yeah. I mean, because there's some transactions where we've made, $2 million on just flipping the paper. So
Yeah.
that's pretty good profit for our investors. And then because we also have some longer lead item time stuff like, buying land packages from farmers and having to subdivide those things. So it depends on where we are, but typically what you'll see is towards the end of a vintage, you'll start seeing acquisitions picking up again because we have a lot of fresh money coming in. And then kind of in the middle of that 3.5 to 5 years is where there's a little bit more of a lull where we're focusing more on, operational and efficiencies and optimizing. Yeah, exactly.
Yeah. Very cool, Fernando. Well, hey, this has been fascinating. Hats off to you, my friend. What you have
Appreciate
done
it.
is really impressive. Very, very smart. Love that. Haven't met any other wholesaler guys who've just made that much of a pivot to something
Yeah.
so radically different. So that's wonderful. As we're wrapping up, Fernando, who are you looking to connect with these days?
Yeah, so I love connecting with other real estate professionals that maybe they're interested in doing self storage, but they may not want to jump off the plane by themselves. So we've done, about 30% of what we do is from other investors bringing us a self storage property or a piece of land that they think self storage could work on,
Right.
but them not being in the industry and just needing somebody to hold their hand. So we'll do co-GP partnerships, and then investors. We just cracked over 1,000 investors. We primarily work only with retail investors. So we don't really take large checks from institutions or family offices. I think our average check size across everybody is like $137,000. So really small check sizes. So we like working with that retail base because it's great when you could help someone become accredited or working with someone that just became accredited to help them double their net worth, things like that. So yeah, and then anybody that may think that they have some type of service for me. So if you're a vendor, if you sell steel, if you sell, security and lighting, things like that, we love hearing from you guys as well.
Awesome. So what's the best place for people to go to connect with you to find out more?
Yeah, you can go to our website. It's ssse.com. So samedward.com.
What does that stand for?
Self-storage syndicated equities, but we are now going the way of IBM. So no longer International Business Machines and more IBM now.
Yeah, well, that makes sense. It's a mouthful otherwise.
Yeah,
What's
easier email addresses, much easier to find us online as opposed to like a 22 character domain name. So
I hear you. Awesome, Fernando. Well, hey, thanks so much for being on the show. This has been great.
yeah, thanks for having me, Dave.
All right, everybody, thanks for tuning in, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.